The latest financial reports for Nigeria's major oil marketers reveal impressive profits growth, mainly driven by the removal of fuel subsidies in 2023, as fuel prices rose from 200 naira per litre to about 1,000 naira per litre. The downstream oil companies listed on the Nigerian exchange, including TotalEnergies Marketing Nigeria, Conoil Plc, MRS Oil Nigeria, and Eterna Plc, collectively posted a profit after tax of about 45.3 billion naira for the 9 months ending September 2024. Now, this represents a 146% increase from the 18.5 billion naira reported in the same period of 2023. So this morning, Bolade Agboola, macros and equity analyst at Chapel Hill Denham Securities, joins me to discuss this. Thank you so much, Bolade, for joining us on the show.
Thank you for having me. Good morning.
Okay, so I'm looking at the figures. Were you expecting such gain by oil marketers in Nigeria at this time?
I expected some gain, but when you say such gains, it's because we are looking at it in absolute terms. If we are looking at it in terms of margins, it is more instructive. If we look at the gains across these companies that you mentioned, yes, we saw in absolute terms that revenue increased significantly. But if you look at the cost to sales ratio, you see that cost to sales ratio has also increased significantly, from about an average of 89.1%, from about an average rather of 88% in 9M 2023 to 89.1% in 9M 2024. We highlight that the fuel subsidy, well, the opinion that fuel subsidy means an increase in the prices of these products. But we also should know that fuel subsidy also means that the costs of these products will be increasing. So I expected moderate gains that the downstream players would enjoy in this period, not significant. And so I believe that looking at it in terms of the margins is more instructive than in absolute terms, like on a year-on-year growth.
Okay, so you mentioned fuel subsidy and, of course, its removal. Aside that, are there other reasons you would want to bring into the mix as regards why we saw these huge profits on the part of the business of the oil marketers? Some other reasons that we might need to also consider?
Yes, apart from the fuel subsidy removal, and like I mentioned, it's not as if the absolute growth that we see translated into higher margins, because gross profit margins across most of these companies were just, the increase was minimal. So another thing I think has impacted these companies is economies of scale. So they've been able to sell more than they would usually do. I'm looking at it in terms of marginal revenue growing faster than marginal cost. So I believe economies of scale is something that was employed in the period, and that's why we are seeing significant growth in their business.
Okay, now, when you look at these companies with the huge profits on the stock exchange, have you actually seen any sort of notable positive impact on the bourse itself? And are these companies viably valuable that investors would want to warm up to now?
So yes, we've seen positive sentiments on the stock, especially since last year when the president mentioned fuel subsidy was gone. So we saw significant rallying on that stock, on most of the stocks in that period last year. And even this year, we've seen some positive sentiments too in the stock. So going forward, I believe that there must still be upsides in the companies, in these companies, but it is dependent on the macroeconomic environment, because there is so much a company can do in terms of managing their operations, or their costs rather. So I think what we can see on those stocks is just some positive sentiment, except there are major policies or major activities that will happen in the nearest future that will drive significant positive sentiments on the stock.
Okay, so just as you said, Bolade, most of the profits posted by these companies were driven by a rise in fuel prices. And of course, there was nothing special that they actually did in terms of operational strategy or decisions, and people just paid more for fuel and their profit rose. Is that concerning for you, looking at, of course, the purchasing power?
It is concerning, given that we already have a high inflationary environment, and higher cost of fuel just, adds more pressure points to that, to the inflation we are currently facing. And it's not, since the market is quite regulated now, so what can be done to ease the pain is not in the hands of the oil marketers. What would naturally bring the prices of this PMS and down will be in terms of exchange rates, right? Because exchange rates is the major factor that is driving costs of PMS. So if the exchange rate worsens, if the naira continues to depreciate further, it means that we'll pay more for this product. But if it appreciates, we would see some relief to the broader Nigerian.
Okay, so now with fuel prices now over 1,000 naira per litre, do you have any insights on how oil companies are adjusting or would have to adjust the operations to sustain profitability, hypothetically, because you've talked about the impacts the naira to the dollar is, and of course some other macroeconomic challenges or market forces could actually influence that. So is there anything they will do in terms of adjustments that can help sustain profitability that would not, of course, have direct impact on the people, if possibly?
While I believe there will be solutions, but it's a quite dicey situation given the current financials, the 9M 2024 financials. We highlight that except for Eterna, which recorded minimal operating expenses, like the growth, that's about 5.1%, others recorded as high as 70% year-on-year growth in operating expenses, which is not surprising given the impact of diesel prices has increased. So if they are transporting their goods from one filling station to the other, from the depot or from their source to their filling retail stations, it means they are going to be spending more on diesel, and then the diesel prices has also increased. We've seen a 59% year-on-year increase according to the MBS as of September 2024. So that is one of the major reasons that we've seen operating expenses increase. I mentioned freight, I mentioned distribution expenses in general. So going forward, these costs are largely fixed, and there is not so much one can do to a fixed cost. What one can manage is in terms of variable cost, and that is why I am advocating, or I encourage that something should be done in terms of the naira, so that we don't see significant depreciation of the naira. And then when we are not seeing significant depreciation of the naira, the costs of the raw materials would moderate, and then whatever margin, because it's a very competitive space, whatever margin that they would not be so much, and so we'll see the price of PMS come down.
Of course, 146% looks attractive for a business owner in that particular field. But then, the profit growth recorded by these companies was irrespective of a 63% growth. You mentioned it earlier in operating expenses, which was further pushed up by forex issues and, of course, the floating of the naira. So will international oil companies that divested before now, that actually divested their investments or outrightly exited the Nigerian oil market, be in regrets, looking at the profits?
So most of the companies rather that divested were majorly upstream, and so it's a different segment apart from the downstream. Looking at the downstream sector, I believe a free market is one that is attractive for any investor, because then they can plan and then they can know how the strategies that they will take to ensure that they remain profitable or continue to be profitable. So I believe that the current market situation is a very good one for investors, and I believe it will boost investors' confidence in the market.
Okay, so let's look at, companies like Conoil and MRS Oil in terms of their operational costs and, of course, their expenses. How would you describe it? Because we've seen that for some other companies, they had robust portfolio, but then some still incurred losses more than others, while some still profited more than others. But then if you're going to look at Conoil and MRS, how would you describe the operational costs in terms of the expenses?
So for Conoil, it was largely due to distribution costs, and which I mentioned earlier, it's not surprising. For MRS, it is, although we saw an increase in selling and distribution costs, but the bulk of it was from the administrative costs, that's like staff costs, costs for consultancy fees. And for companies that recorded more profit than the others, and I'm speaking specifically to Total, we highlight that there's a provision that was written back in the financials, which amounted to about 12 billion naira. And I believe that also supported their earnings for the period in 9M 2024.
Okay, so in light of Dangote Refinery's PMS production, now, what impact can we expect on the revenue models of major oil marketers in Nigeria? Are we looking at more profits, marginal gains, or reverse gains?
I don't expect any significant change in the performance of these companies. Like I earlier mentioned, it's a very competitive market or space rather. And then in terms of how they can mark up or earn in terms of margin, it is also stiff. So what I believe that the Dangote Refinery will be doing for Nigeria and the oil marketers at large is availability, increased supply. So it reduces the amount, the times at which we have to we say that there's fuel scarcity, reduces the long queues that we are seeing across the nation. So in terms of revenue and how revenue will grow, I believe it is more on the back of the oil marketers themselves in terms of how they are managing their operations to ensure that they remain profitable and how they employ economics of scale, like I mentioned, ensure that marginal revenue is growing faster than marginal costs so that they will continue to record significant growth and in turn record higher profits.
So now that we've even seen that NNPCL has stepped down rather as the sole importer, of course, the sector is fully deregulated. But then do you think it would have an impact on the sourcing of the petrol itself among the oil marketers? I know you have mentioned a part of it before, but then I'm looking at how this competition, most especially for Nigerians, can actually drive down the costs of purchase of this particular commodity. So is there a possibility in that also?
So NNPC not being the sole importer is a good one in terms of how efficient the market will become. And in this term, I mean that they'll be able to compare prices, amongst players or in the industry or amongst people that they source the products from, and then they are able to be effective in how they do their business. So I think in that case, what the benefits to oil marketers is in terms of efficiency of the market. And we also know that even if you are importing, it will still mean that there's an element of FX in it. And so, there might not be significant changes to the pricing in general, but we just like I mentioned, efficiency in the market is what I believe this would do.
Okay, so finally, Bolade, before I let you go now, just to wrap things up, over 90% of these companies' revenue come from fuel sales, so to speak. So is it possible that this lack of diversification that we've seen could be risky if there are future changes in the fuel markets?
So if I'm to get your question very well, because 90% of their revenue is from
Fuel sales, yes.
PMS.
Yes.
So it's diversification is the best thing actually, right? To be able to have opportunities to source, compare prices, and come up with the best strategy that works for individual companies. So I believe that while Dangote Refinery is a very good one for Nigeria in terms of the volume or supply it does to the Nigerian government, or sorry, the Nigerian economy, and for the oil marketers in terms of the supply. I think diversification is also a good thing to happen, so that like I mentioned earlier, it will allow for efficiency in the market. And there's also a need that both standards, like we are not getting double standards of products across just because we want to diversify. So it's a dicey situation. I believe that Dangote Refinery is a good one in terms of ensuring that we have adequate supply in the economy, or in the country rather. But diversification is also something that is welcomed, as far as we are not getting adulterated products, and companies are able to manage their costs effectively.
Okay. Bolade Agboola, macros and equity analyst, Chapel Hill Denham Securities. Thank you so much for your time on the show.